Well, good afternoon and welcome to HIROC's weekly webinar, where we will talk about what we see happening in the global economy, in financial markets, and the world of wealth management, and how all of this impacts our decisions on the best courses of action for our and your investment strategies. Now, as you all know, we invest our money in the exact same models as our clients, and we think that this defines the true nature of our prudent and disciplined investing strategy. Our discretionary management enables us to make quick decisions and execute them immediately for all of our clients simultaneously, which is especially important in volatile markets as we take advantage of opportunities that avail themselves to us. I'm Scott Tomlinson. My partner and colleague Paul Tepsich, the founder of HIROC, is also with us, as is our financial planner and wealth forecast specialist, Bianca Tomlinson. We are recording this webinar so that those who can't join us live can tune in when it is a bit more convenient. If you are a first-time listener and would like a little more information about our private client services and our disciplined investing strategy, we have a separate introductory webinar that will provide you with this on our website under the Private Client Division tab. Well, it's time to bid farewell or possibly good riddance to our themes for 2016. So how did we do? Well, our overriding theme for 2016 was that financial markets would remain volatile. They began the year that way with plenty of economic uncertainty. June brought the Brexit surprise, November the Trump surprise. The U.S. economy survived slow growth in the first half of the year to pick up steam in the second half. Now, our recession call has yet to be realized, but we didn't think it would play out in 2016 anyway. Commodity prices appear to have rallied to stave off deflationary forces. Central banks were able to keep volatility from accelerating, but unable to fuel sustainable growth. Geopolitical issues have risen to the forefront, making economic decision-making more complicated. Likely this will be a key theme for 2017, especially in the Eurozone and how the populist movement evolves there. As well, U.S. trade relations will be crucial for the future of the U.S. economy, and President-elect Trump has definitely not started well with China. Well, bond markets briefly lost their leadership role, but have got it back, telling us that inflation expectations and deficits are rising. And equity markets remained an expensive place to invest throughout the year. Our benchmark index has returned a mild 6.75% this year to date, but with bond yields now offering significantly better returns, with 10 years at 2.5% in the U.S., it makes equities even less appealing going forward. And we have seen our benchmark balanced portfolios returning less than average returns of close to 3% after fees for the last few years. Now, with inflation heading back towards 2%, this does not leave much room for real growth, but the risk-free rate of return for 90-day T-bills remains at or close to 0.5%. So to get better than inflation returns, investors must take risk. But it is the type of risk that they are taking that is crucial, and that is how we have successfully beat the benchmarks this year. And next week, we'll have our themes for 2017. Let's have a look at what has been driving markets over the last week. Election volatility in stock markets has calmed. This is actually over the last 2 weeks because we didn't have a call last week. But election volatility, stock market volatility has calmed. In fact, since the Brexit vote, stock markets are less fazed by the ongoing developments, thanks to the continued stimulative central bank monetary policies. However, bond markets have experienced significant volatility. Balanced portfolio have seen most of the gains from the stock markets post-U.S. election erased by their bond exposure, and then some perhaps. Well, investors have pushed the fear and greed index back into greed territory, and as you well know, we would rather sell into greed and buy into fear. So we're certainly not looking at being buyers at this particular moment in time. We compare the performance of our global equity model to the performance of the MSCI All Country World Index, which includes close to 2,500 companies domiciled in 23 developed countries and 23 developing countries, and covers 10 economic sectors. We want to maintain a global focus so as not to be susceptible to what is called home country bias, where investors are under-diversified and take on greater amounts of risk by being too exposed to assets of the country that they live in. It is also important to remember that many of the companies in our benchmark index have a global perspective, so we also need to keep in mind that it is the companies that we are investing in, not necessarily the countries. Well, stock markets are a little higher since our last call. Year to date, the total return for the benchmark index is 6.71%. Over the course of the last year, it's up about a little over 4%. The same over the last 3 years, and over the last 5 years, about 8 3/4. Well, the Canadian bond prices, as measured by our benchmark index, ETF XBB, are lower by about 3/4% since we last spoke. Year to date, the total return is 1.62%. 1 year, 2.67%. 3 years, 4.39%, and 5 years, just 3.14%. So you can see how bond markets have been pulling back returns over the last few weeks. Well, if you combine the equity and bond indices into a balanced scenario and allow for fees and MER costs, the total benchmark return for a 60% equity, 40% bond index combination year to date is 3.62%. For 1 year, just 2.4%. Over 3 years, 3%, and the 5 year is sitting at 6.37. Now, a slightly less growth-oriented portfolio with 40% equity and 60% fixed income has returned 2.61 year to date. Over 1 year, just a little over 2%. Over 3 years, a little over 3%, and the 5 years about 4.25%. So what you can take away from this is that, as I mentioned earlier, while the 5-year returns are at or close to the long-term average, shorter-term returns are not. For the last few years, we have seen below average benchmark returns for balanced portfolios. So when we look at the portfolio of a HIROC client who started with us in January and has a 60-40 balanced portfolio, which includes underweight exposure to equities, recently adjusted exposure to fixed income, and also more exposure to non-correlated assets in our tactical model, the total return this year to date after fees and costs is a 631. The combined fully invested benchmark total return after allowing for fees and costs over the same period is a 3.62%. So our defensive strategy with lower exposure to the equity market than the benchmark and greater exposure to non-correlated assets through our tactical model has had significantly better returns. For our client, that's lower volatility, better risk-adjusted returns, and a better overall return. Well, after fees and costs, the 1-year performance of a 60-40 HIROC client is a 4.57% return compared to the combined benchmark at 2.4%. Now, the longer-term 4 years and a few months total return since inception of this particular client is a 761 versus the benchmark of a 4, just about 4 3/4 over the same time period. I am also required to remind all of our listeners that historical returns are in no way a guarantee of future returns, although at HIROC we do work very hard to try to get the best possible risk-adjusted returns for our clients and ourselves at all times. Well, oil prices are higher since our last webinar. OPEC agreed to reduce production on November the 30th, but pumped a record amount in November. So it remains to be seen if the new agreement will be impactful. Meanwhile, commodity prices, as measured by the Bloomberg Index, continued to break out of their recent trading range since the highs of last June. Well, the U.S. represents more than 20% of the global economy, and over 50% of the companies in our benchmark index are domiciled in the U.S. So we keep a very close eye on what's happening there. Well, U.S. unemployment dropped to new lows at a rate of 4.6% with the November data that was released last Friday. Now, our metric for the potential for a recession is the convergence of the actual unemployment rate and the 3-year moving average of that unemployment rate. Well, that convergence actually widened, so it was more of a divergence, pushing the chances of near-term recession a little bit lower. However, the labor force participation rate shrank, which means that fewer people were actually looking for work, and this could change as the Trump era is shuffled in and potential workers return to the pool of those willing to work. With close to full employment, the U.S. Federal Reserve will likely raise interest rates by 1/4% on December 14th, but that is basically playing catch-up to the bond market, where 10-year yields have moved by close to 0.75% over the last month. Governments, households, and businesses with heavy debt loads are now facing significant additional costs to service their debt, and that could be a problem moving forward for the global economy and the U.S. economy as well. Now, the number of men and women between the ages of 25 and 54 who have given up looking for work has been increasing since the technology revolution of the late 1990s. The Trump administration hopes to reverse this trend. More people looking for work could, in fact, push the unemployment rate higher if they cannot find jobs. Well, the real key will be how the level of productivity responds, and this will require businesses to have the confidence to invest in new and productive methodologies. Since the Great Recession, corporations have had more desire to purchase their own shares than to invest in development. Trump is proposing to lower taxes to spur this on. However, his trade protectionist rhetoric may have repercussions that reduce U.S. companies' access to foreign markets, and this could also be a problem. Well, elsewhere in the global economy, we await the latest in interest rate policy from the world central banks, and that starts with the Bank of Canada tomorrow, the European Central Bank on Thursday, and then, of course, the U.S. Federal Reserve next week on the 14th, followed by the Bank of England on the 15th, and then on the 20th of December, the Bank of Japan. So lots to hear from central banks, and we'll keep you posted as we go through that period. Well, in Europe, the no victor in Italy gave the populist parties greater credibility, and they now will also favor a referendum on the euro. So 2017 is going to be a very telling year for the populist movement in Europe, especially with national elections in the Netherlands, in France, and in Germany as well. And we can follow the latest volley of geopolitical intrigue between Trump and China. China's response to Trump's tweets showed us a glimpse of the potential for a trade war, and it certainly cannot be inspiring for business confidence, because China is the second largest economy in the world, and certainly to continue to evolve the U.S. economic situation, the U.S. needs to be trading with China. We'll keep our eyes peeled to how that evolves as well. Well, where is all this taking us? Well, let's check in with the bond markets that normally lead other financial markets and have been a major source of volatility recently. The U.S. bond market continues to build in a scenario which entails more bond issuance and higher inflation on the back of proposed Trump policies. This has pushed yields higher and steepened the yield curve. The 10-year note yields have moved close to 2.5% from pre-election yields of about 1 3/4%. 30-year bonds are now above 3%. Stronger than expected employment growth in Canada pushed bond yields higher this week as well, but not to the same degree. As mentioned earlier, the Bank of Canada will announce its intentions tomorrow. There's little change in the UK curve. Brexit still hangs over the future of UK economic growth, and the pressure is building to get a deal done, but that deal will not likely be good for the future economics of the UK. German euro yields rose after a muted response to the Italian referendum and some improved economic data. And in Japan, yields also rose and the yield curve steepened with an improving economic outlook there as well. As for equity market value, since the election, stock prices have risen by about 5.8%. Meanwhile, earnings for the fourth quarter have been revised lower by about 2%, so that gap has widened significantly. Now, for all of 2016, S&P 500 prices are higher by a little over 8%, but earnings growth for the year is expected to show close to no growth at all. Now, this means that equity investors are already putting a great deal of faith in 2017 earnings, which are currently expected to show growth of near 11.5%. While building that optimism into the future already, the 12-month forward price-to-earnings ratio is currently at an expensive 16.7 times, relative to the 10-year average, which is at 14.3 times. As a whole, stocks have priced in all of the good news and possibly more. Well, for well over a year now, we have taken a cautious and defensive posture to investing because of our concerns of heightened levels of volatility. In the end, volatility came to us in the bond market more than it actually did in the stock market. But despite our caution and our desire to protect our and our clients' money by taking less risk, we are well ahead of the fully invested benchmark returns. Part of that success of our year-to-date returns comes from what we have been able to achieve in our tactical model. We have been active through a combination of intrinsic value trades to strategic trades in energy stocks and high-yield bonds, and some event-driven trading that came to fruition in early October. Now, this unique signature model has added considerable non-correlated value to our client portfolios over the course of the year and allowed us, in the end, to reduce our exposure to other overpriced assets. Paul, anything to add on the tactical portfolio?
Yeah, thanks, Scott. We actually did a bit of adding for most client portfolios. Some were underinvested within our fixed income. So just within the fixed income model, not specific to tactical, we did put some high-yield bonds into the fixed income portion. Probably about 5 lines of various high-yield bonds. These are higher-rated, more stable high-yield bonds. Within the tactical model, we haven't had a lot of change over the last couple of weeks. And although oil has popped up a little bit on the back of an OPEC agreement, some of our positions, although higher, are not quite, they're kind of actually following oil. I mean, oil has been higher over the course of the year without an OPEC agreement. So I'd like to see more follow-through in oil, and I think we'll eventually get some follow-through, but we still have some very specific positions that I think, certainly one of them, we own both stock and bonds, and I think it will be taken out eventually by a competitor. So we've got some positions in there that are strategic, and I think still hold some pretty good value for us over the next, say, 3 to 6 months. That's it.
Thanks, Paul. That's great. Now, last week we had a press release from the Bank of Nova Scotia, and I just thought that if any of the anybody had seen that, it might be helpful to perhaps give our clients a bit of an explanation for it.
Sure, I'll do that kind of quickly. This is a closed-end fund. HHY.UN is the ticker, as you can see on the screen. We manage 4 of those closed-end funds for a division within Bank of Nova Scotia called Scotia Managed Companies Administration, Inc. This fund specifically, HHY, the High Rock Canadian High Yield Bond Fund, was quite small. It was about $11 million worth of outstanding. And with the annual redemption right, which allows investors to get out at the net asset value, which typically is higher than the TSX trading price on the units, it allows them to get out each year. In this specific fund, November 15th for December 30th or 29th or something. Oh, there you are there on December 30th. So we had redemptions in this fund, although the performance of this fund was quite good. I think it's up north of 20% year to date. Sometimes that works against us, and investors want to sell what's gone up, which sometimes we agree with that. Nonetheless, because the redemptions were of a decent enough size, the MER, or the management expense ratio on this fund, dropped down, or pardon me, moved up from around 2.25% to over 4%. So the OSC, the Ontario Securities Commission, puts a bit of pressure on fund managers like Scotia Managed Companies across the country, and it is the right thing to do to dissolve and terminate this fund. It's just way too high a management expense ratio to have on a fund that small. So I think the question would be, you know, if you held this fund and your advisors didn't put in for redemption, you should probably ask them why not, because the fee on this fund would have been exorbitantly high and out of market. As by way of comparison, the other larger fund that we manage, which is around 25 million now, AHY is the ticker, the Advantage Canadian High Yield Bond Fund, is about 25 million and has an MER all in of 1.84%, which is more in line with other similar funds in the marketplace. That's it.
And just for clarity too, for our clients, and thanks for that explanation, but for clarity too, a number of all of our clients at a certain point in time own these funds, but as they transferred over to be with us, we liquidated them from those funds at the appropriate time when we had these kind of redemption options to do that, in order to take them out of the management fee that they would have had to pay, right?
Well, that's a good point to add, Scott. So that I was in London, Ontario, meeting with a retired couple on Sunday late afternoon, and I said one of the biggest benefits to High Rock is our ability to get high yield bonds and other corporate bonds, investment grade corporate bonds, and even, quite frankly, government bonds on the screws pricing. So we have the intellectual capital and the experience and the access to these bonds to manage high yield directly for our clients, so they're not paying 4% or even 2% MERs on that portion of the portfolio. That's one of the biggest advantages to High Rock, in my opinion.
And it reduces, it reduces, even if you own an ETF that has an MER, we reduce the cost to clients from that perspective as well, right?
Absolutely.
Yeah. Okay, well, thanks for that, Paul. That's great. That is it for today. I want to take questions if anybody has any questions. Okay, no questions. But if anybody who is listening to the recorded version has questions, please feel free to email them to us. We certainly appreciate all the feedback that we do get. We want to make sure that we're talking about things that our clients want to hear about, so please feel free to send feedback as well. But always, as always, thank you for taking the time out of your busy schedule to tune in. Don't forget to tune back in next week. But until then, this is Scott Tomlinson, and we are signing off.